Welcome. In this short video, we're going to talk about the management of trades, and we're going to talk specifically about where to move your stops, when to get out of positions, and then when to let your positions run. Now, before we get started, let's talk about the most important thing and the objective of why you're day trading in the first place. You want to be able to make money. You want to make a lot of money. And what we're going to show you in our trades and we only teach two trades, trend trades and counter trend trades, or trading from the edges. And we're going to show you how to make at least $200 per trade, and we're going to show you how to make a bunch of these trades a day. Now, the objective for us is to make at least $400 per day per contract traded, assuming we're trading gold or crude oil or the S&P or some type of futures market or Forex market. So for us, consistency is the key. It's not just consistency in the entries and the logic for getting into a trade. You have to have consistency on your management. And the objective for us is to be able to make $400 a day. And if you can make $400 a day, you can trade a $3,000 account and trade one contract. And if you make $400 a day on the average every month, every contract should earn you around $8,000 per contract. After you have spent multiple months trading one contract and being successful, then you can start compounding that. And ultimately, the result, if you do everything correctly and you're averaging $400 a day, is that you're going to be able to make a lot of money. So we're all in agreement. We all want to make a bunch of money. When we look at our charts, before we ever place a trade, I want to put an idea into your head. I want the idea to always be with you every single time, no matter what. When you're looking at your charts before you place a trade, and this is going to be the secret to your trade management. The secret to great management is to place trades that barely need management. I know this is kind of silly in the beginning when you think about it, right? If you only take trades that have the highest probability of winning and every indicator supporting that trade position, you don't have to really do anything. You just have to get into your position, move your stop once or twice, and wait for your profit. So again, I want you to think about this as we work our way through the management side of things. The secret to great management is to only do great trade setups that barely need management. Now, of course, this goes without saying. You should be willing to take a trade 100% of the time. If you're unwilling to take the trade every time and you're unwilling to risk at least $100 on that trade, you should not do a trade whatsoever. Usually this is dictated by the trigger lines and the background colors on all of the charts are green. Another rule of thumb for you, never move your stop until you actually have a reversal bar in the market. Meaning if you're going short, you're going to need a bar down before you move your stop, or vice versa. And we'll take a look at a bunch of examples of this. If you get into a number one trigger line and Fibonacci trade look, never exit your position until you're either stopped out or you have hit your profit target. And again, I want you to think about this, maybe even print this out and put it up on your wall. Don't get out of your trade if it's a number one look. If you're in a transition look, take the money when you hit a profit target, or if you have divergence against yourself, protect yourself at all times. And if the colors of the background change against your position, you're going to be more assertive in managing your trades. If you implement these rules, that's all you're going to need to know. So what I'm going to do in the slides, we're going to talk about a couple concepts. Buy low, sell high. Everybody talks about it. It's been an age-old, saying that everybody says, but for us, it's a visual representation of what we're supposed to be doing. So when you're putting a trade on, Number one, you're going to have the right color background, you're going to have the right trigger lines, you're going to have the right Fibonacci support, you're going to have everything in your favor to go long, and you're going to buy on the way down. This is where most novice traders mess up trading completely. They want to wait until the market actually goes up because they feel safer. You're going to make more money and you're going to risk less if you buy on the way down. That's why our software will help you pinpoint these perfect trades so much better. Because when you buy on the way down, once you actually make the up bar, and we're going to place our stop below the pivot, you're only going to be risking, you were risking 100, but after, if you've got the right spot, you're going to end up risking average between $40 and $70 per trade. Almost all of us are going to not feel very bad about only risking $40 or $50 on a trade, getting the right spot. We also want you to think about the concept of selling or exiting a position on the way up. And again, we see too many traders wait for it to hit a target and then start going down, and then they exit on the way down. So again, I want you to keep this in your head. Buy low, sell high. And when you see it on the charts, it's going to be representative by buying on the way down, selling on the way up. Obviously, if we're doing short trades, same thing. Now, we spend a lot of time on reading our fibs and reading our trigger lines, as you've seen. So again, just to kind of go through some terminology so we're on the right page. If your small triggers are physically getting below all of the other triggers, you're in a transition look. You remain in a transition look until the synthetic triggers will cross. If the small triggers are down, below the large triggers that are down, below the synthetic triggers that are down, you're in our number one look. And then ultimately, towards the end of a trend, you'll see where the small triggers and maybe even the large triggers all come together. They get inside of each other, and this is where we have to protect ourselves. Then you see the same thing in reverse. Small triggers really wide and going up, above the large triggers, above the synthetic triggers, number one. Getting inside, it starts to weaken. And again, we've got some specific management rules that we're going to use. You're going to see this in the video. When you are in a transition look, you are going to pay attention to your smaller chart areas and divergences and whether or not the synthetic triggers on the 14-2 chart cross over and come along for the ride. If they do, great, we'll keep going short. If they don't, we may have to stop going short. You'll see that as we go forward. If you're in a number one look, again, relax. You either get stopped out or you get your profit target. Don't let little things bother you when it's in a number one look. And then ultimately, when we're weakening or the small triggers are getting inside, we have to pay attention to divergence, Fibonacci areas, and pivot stop outs, because those are the things that will terminate the trend. Again, this is more of the same. I wanted to really drive home the point of looking at your triggers. When the small triggers are crossed up and transitioning, you will do a long trade, period. If the small triggers are really, 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 really strong and way above the other triggers, you can relax. You're going to do a long trade. Again, this is repeated with number one looks. And then look, up here at the top. See where my pointer is? You're going to do a trend trade here. I promise you. You're going to get a trend trade. And now that the triggers are inside of each other, if you have divergence, this is where you normally will get a pivot stop out. And again, you recognize the divergence. You'll use it and exit. You'll buy again one more time before the market goes up again. Again, as the market's going down and you transition up, if you go long and you run into synthetic triggers, be defensive. If the small triggers break above, you're going to go long. If the small triggers weaken inside of the large triggers, you're going to be defensive. Same thing, one more chart look. I just want to do one more and then we'll look at some examples. If the market is going down really strong and you get a bar up, if the small triggers remain crossed down, you're probably going to keep going short, especially if you have resistance here. If the small triggers are weak but they actually roll up, you're not going to go short anymore. You're going to be doing long trades, maybe one or two of them. If the synthetic triggers don't cross, which you can see in this case, there's no chance. Once the small triggers cross back down, we'll be going short again. Again, once the triggers weaken, we're going to watch out, and ultimately paying attention to whether or not the synthetic triggers get crossed up or down is going to be really key for us, because we're probably going to do a trade here and it's probably going to fail right here on the small charts, and we have to recognize where this synthetic trigger is. It's very, very important in what we do with management. So let's take a look. Again, general concept here, okay? Every trade you do, no matter what, if you're unwilling to wait for the reversal bar so you know where to put your stop, don't do the trade, period. Sometimes we get within a tick or two of the perfect spot. Sometimes it goes a little further. It doesn't matter. You wait, no matter what, for this bar to go down before you move your stop above the high. And the simple reason for this, the high price, I want you to think about it. Look where my little laser pointer is right there. That's the price in which no human being on the planet, no algorithm, no system, no fund manager, no crude oil trader on the planet was willing to buy the market past that price. And the sellers came in. So naturally, we want to buy, get out of our position or put our buy stop beyond the price at which nobody else was willing to buy. So it gives us a very definitive, hard, fast spot to put our stop, so we don't pull our stop down too early, we don't mess around, we wait for the down bar, or we get stopped out. Either way. Okay? Same thing here. I'm going to show you this is the same logic. The market's going up, we're buying on a pullback into our spot, always buying on the way down at the spot. After we get an up bar, we can then reduce risk and move our stop below the pivot. If the market's going up, again in a strong number one look, we don't worry about divergence. We just wait for a new bar to the upside, and then we will reduce our risk again. So you can see the stop was placed here after the up bar, and then ultimately we want to make it up to our next target. So again, patience and allowing these new up bars to dictate when you're going to move your stop is going to give you the opportunity to make a lot more money. Now, vice versa. Remember where we said if you're in a transition look. So again, look, this is where the large synthetic triggers are, they're plotted on all three charts, so we have symmetry across all the charts. You're going to be short, period. There's no way around it. You're going to be short, and because it's a transition, meaning our synthetic triggers are crossed up, once you reach a prior low or divergence low or support or anything, you're going to get your stop to where you're not going to lose money. Hopefully it keeps going. It should, because of the triggers, but because you're in a transition, you want to be protective when you get to a pivot stop out or any type of Fibonacci resistance. You want to make sure you don't lose money. Understand? Not losing money is very important. Again, keep in mind, $400 per day. That's all we need. So we want to do a couple of 20-tick trades where we make $200. That's the recipe for getting rich. Consistency, consistency, consistency. So again, look, I want you to see what a transition looks like. So again, this is the 8-2 chart on the left side. I didn't show you the 14-2. You can use your imagination here. But When the market pulls back to a pivot stop out or a fib or whatever, we're going to be doing our trend trade long. I want you to see the magic of $200. We go long on the way down into the trigger and pivot stop out window, and then we take $200 on the way up. And then if the market retraces back to the triggers and a pivot stop out, we go long and we take $200 on the way up. And then if the market breaks through and continues, then we buy the mid band with our triggers and we take another $200 on the way up. So in essence, we've done 3 trades before the synthetic triggers have ever crossed up. And again, I want you to think about something. And again, I don't know how I can jam this home any further. $400 is our objective. If you're in a transitionary period, take 200, take 200, take 200. This whole sequence took 37 minutes. So you're talking about 150% of your daily goal in 37 minutes. Trust me, 200, 200, 200 when it's in a transition period is the magic formula. Now, let me show you again transition, because look, number one look, that's pretty easy, right? I mean, I think everybody can understand it. All the triggers are going up. So a lot of the management that you'll be doing is when you're in a transition, meaning the synthetic triggers have not crossed up yet on all the charts. Still, the number one thing is super strong triggers over here on our 14-2 chart. So we're going to do a trend trade, right? Pull back into Fibonacci support and the 8-2 large triggers. And again, this Fibonacci support at 57 is the closest support to the large triggers on the 8-2 chart. This is how you differentiate your entry spots, because it's tempting to go long at 63 and it's tempting to go long at 61 because that's your mid-band and fib. But when you're in a transition, especially when you're in a transition, a number one look you can get away with going a little earlier, but in a transition, you need this deeper pullback into the large triggers on the 8-2 chart. It's going to pinpoint the perfect location for you, and then you're going to go long, and then lo and behold, if you hit, now this, again, I took off the indicators on the larger chart just to make it easy, but this is your 14-2 midband, the dotted magenta line. You go long at 57, let's say, and then at 77, you have 20 ticks again. Then the market pulls back and you're going to have the opportunity to do a second trade, assuming that your 8-2 triggers haven't changed, which they haven't. So again, the magic of taking 200, watch. Now the next trade. We have a little more of a lesson here on this one. Again, it's the same situation. Large chart, super strong triggers going up, transitioning, cool, everything good. We pull back to mid bands and fibs that are inside of the 8-2 trigger. So we're going long probably at 64, let's say 56, 64. And we put in an up pivot. Now, this is where it gets a little bit trickier for you. I want you to think about something for a second. Because of the overwhelming strength to the downside on the small triggers and the fact that we could barely close above the strong triggers down, what I'm telling you is that you have to delay moving your stop below that pivot. And this is really the only case when you have a really strong trigger against you, because sometimes they go a little lower and then they turn back up and they take off. So what would happen in this situation is you would end up getting stopped out, and then you would watch all that money go away and you wouldn't be able to get back in. So the lesson here is, if the 8-2 triggers or the triggers are everything's still in your favor. Look, 14-2 small triggers are climbing fast. The 8-2 large triggers are climbing fast. That's the giveaway. That means you're going up. So This is where the 5-1 small triggers suggest you should wait until they actually turn and pinch and roll up a little bit, so maybe 2 bars up here. Then you can lock your stop in below the low, not get bumped out. So again, this is the one exception. Super strong small triggers down. You were willing to risk $100. Don't lose that willing to risk $100. Just recognize that it's really strong, so you wait for the triggers to roll, and then you avoid the little pivot stop out right there. Trust me, this happens all the time, and you'll see how consistent this one is. Now, same thing when we buy the bottom, right? If we're going to do a pivot stop out long from the edge of fibs, again, look at my pointer over here on the 5-1 chart. We're going long at 29.76 or lower, or tick lower even. We're going long at the blue line and the fib right there. And every time you do a counter trend trade or trade from the edge, you do not wait for the triggers to roll. It doesn't matter. You put your stop below the pivot and you wait and you hope that it goes up. There's nothing else you can do. And because a lot of times when you're buying the edge, not everybody's totally convinced yet, so sometimes they bounce around quite a bit before they actually take off. So you have to, especially if you get the low tick and you've only got a 3 tick. I mean, look, if you were long right here at 29.75, you'd only have a 2 tick risk, literally $25. So don't worry. Just relax, let the whole thing marinate, wait for a new low pivot, and then you can move your stop, then your break even plus. Let it marinate, another low pivot, another up bar, then you can move your stop again. You have to be patient when you're trading the edges because, look, we're only going to take one attempt at the edge. So don't move your stop up too fast. Don't get scared. You've got the right spot. You've got a very low risk. Let the trade marinate so you can get paid. Any counter trend trade that you do, once you reach resistance, it's time to take your money. It's just the way it is. You can hold on and hope for more, but it's usually best if you don't. Because once you hit resistance, especially when it's the first run to the upside, you're going to pull back and then you'll get another chance at a trend trade. Almost every time. So again, don't be too, granted this is, 8 S&P points. I mean, that's $400 a contract. So running into resistance, you take that money. All right. Now, the flip side of that is, because look, I want you to see a counter trend trade or a trade from the edges, but it's against the color. So again, think color of the background, color of the background, color of the background. Over here, it's green, green, green. Don't worry. Okay? You're long, it's green. That's the good thing to do. In this next slide, we're short, but the background is green. So again, if you're in a counter trend or an edge trade from the edge and you're against the triggers and the colors, take the quicker money. It usually works out best. So make sure you get your first target and then you get your stops down very quickly because usually this will hold and it'll go back up again. So again, whenever you're doing counter trend trades, the background is green, green, and green. Take the money, take the money, take the money. Easy enough? All right, same thing. If the market is trending down and you go short, the flip side is true. So let's just say, hypothetically, you sold 56.79, which would be an appropriate thing to do. If you find yourself short and the background color turns green, number one, your stop's going to go above the pivot, so you have a stop in place. But number two, if it's green and you have divergence, meaning you had 2 bars up, get out. Don't hope, don't wish, don't pray. There's nothing you can do. You get out of your position when you have divergence and a green background and you're short, period. Got it? Let's go forward. Here's another example. Again, look, I want you to start on the left side on the 14-2 chart. This was a really strong trending day, and this is a very typical scenario in a strong trending day. It's going down. You want to do shorts, nothing but shorts and only shorts, period. But the small chart doesn't make it easy. So you're going to be short right here for sure, 100%. And you're going to recognize, you're going to say, oh, John said if the background color is green and I get divergence, get out after the second bar. Because what happens is they usually are going to go stop out the high. And remember, our stop is above the high. Think about it. If it's green and we have divergence, which means it's going to take out the high and our stop's up here, that would be silly. So we're going to get out after the second bar up, anticipating that stop out, and most people will get back in short, with, especially if we have a divergence line there, it's a lot easier. In this case, it's not, but if you go short again, you're short because the large chart says you're going down, but you have a divergence potential and you get out after the second bar up, knowing that they're going to stop out the high again, at which time you can use your market flow or go short after the triggers roll over. And you'll catch the move eventually, but this is a very, very typical scenario. And again, if it's green and you're short, 2 bars up, you're out because it's going to take out the high almost every single time. Now, I wanted to show you a mismanaged trade. We did this one in class and we talked about it, but I want to show it to you here because it's really obvious when you see it. This is a mismanaged counter trend trade short. Profits not taken, risk not reduced properly, and watch what happens. The short was great. I mean, look how awesome that short is. It's a couple ticks off the high, which only gives us a couple of ticks of risk because we get a pivot down. Every chart is green, and we hit support and mid bands and green and support, and the triggers are up. 2 bars up, and we should be out of our position. And again, this is where people get very stuck. If it was red, sure, hang on for dear life. If it's all green and you're short and you get divergence, get your butt out of the trade after the second bar because you're going to stop out the high. Almost every time. So I want you to see what happened. Instead of getting out after the second bar and making 2 ticks, we lost 2 ticks. And you may be saying to yourself, I mean, look, it's only 2 ticks, no big deal, right? $20. But that's not really the case. So, and again, look, you can see obviously going forward, you can see we have a long trade coming. We won't talk about that, but you can see it pretty easy. The mismanagement is not getting out with a green background and not taking 2 ticks and losing 2 ticks. Let me show you what it means. Every tick matters, guys. That 4 ticks difference, think about it. You could have made 2, but you lost 2. So it's 4 ticks difference. 4 ticks times $10 per tick, assuming 4 trades a day and 250 trading days in a year, 4 ticks really means $40,000 per one contract on an annual basis. So if you're constantly giving up 4 ticks of your profit and you do it 4 times a day, the real world cost on only one contract is $40,000 over a year. Keep in mind, it's only $1,000 to day trade a crude oil contract. So you're talking about 4,000% less return on margin. That's huge. Every tick matters. It is not okay to lose 2 ticks when you should have made 2 ticks. Make sure you manage your trades properly. Now, obviously the trend is up here, and we're going to be doing a pivot stop out trade at the bottom. Again, sometimes when you're with the big trend, which means with the synthetic triggers going up, you don't always get divergence first, but we're going to buy the double bottom. Again, stop below the pivot. When the market takes off, you're going to wait until it goes down, and then it makes another up bar, and you're going to trail your stop below the pivot. And anytime you get back to the synthetic triggers from the wrong side, that's where you're going to take your profit. It might go higher. We don't care. When you hit the bottom of your synthetic triggers from the wrong side, you take your money, or at least get your stop really, really tight, because this spot usually will make the market turn. Now, one of the other concepts that we use when we talk about stopping, don't do any more trend trades, is triple divergence. So if you have divergence on all three charts, stop going long, that's the rule. We incorporate that same rule when we're talking about management, because if you look at the large chart over here, we're going long, period. Right? Breakout of fibs, everything's good, we're going long. And this is something that happens very often, where you get divergence and then you get a second divergence and you're like, that's okay, everything is still good, we're going to be going up. And if you get a third divergence on a chart, 2 bars later, you're out of your position, period. It's also when we stop taking long trades, and it's also when you exit long trades if you find yourself in a long trade. Got it? There was one that we did in class yesterday. This is literally the end of the day yesterday. We were short. My wife was actually short at 55.29, and most of the people in the class were short there. And we had a number one look. I mean, it was really strong, so we ignored divergence, and we ignored the second divergence, and then the class was coming to an end, and I said, look, guys, if we get a third divergence, meaning, we get to about 55, 27, or 28, we need to be out of the position, because 3 divergences on the small chart for the first time usually will reverse the markets. Lo and behold, it did. We made 1 tick, no harm done. Again, it's a matter of when to hold and when to get out of there. Now, again, when you're doing a trade, guys, and you're deciding whether or not you're going to hold on or you're going to manage or get out, I want you to think about something. Watch, especially the 8-2. I mean, the 14-2 triggers too, but the 8-2 are even more responsive. When the small triggers are super strong below all the other triggers, you pretty much just wait for retracements, and then on every new bar down, you lower your stop, and then you wait for your target. Again, when it's really strong, you don't really have to manage very much. You want to pull your stop down at the top. You want to pull your stop down after a new bar, and you don't want to let anything scare you out of making your money. Now, if you're short, one of the other things that you'll see happen a lot, this goes back to the strong trigger line situation. If you're short and for some reason you're in a transition or weakening and you get divergence, you have to get out of your position if there's no chance of the small trigger lines rolling down at all. Almost always it's going to stop out the pivot, and you're going to be able to get a better entry. So you might get in here, you might get out break even, you might even get in on a pivot stop out, and then again, management issues will kick in. Look, if you're short and the background color is green and you get a chance to get out of your position break even, take it. Period. Just take it. Don't worry about what happens next. If it's against you and it says, hey, that's support and it's green and you're short, get out. Now, you will see another situation where everything looks great, right? We're going to go long. We buy right there. Yay, we got our price. And then, it went a little below. And again, remember, in a transition, we have to manage things differently. We can't just hang on forever. So we're going to buy 55.43, let's say. Our stop's going to be down here at 33, so we didn't get stopped out. We're going to move our stop below the pivot, and then we're going to recognize that because our small triggers are now below the large, if we get divergence, meaning second bar down, we're going to get out of the position. Because usually when we're in a transition, if we get divergence, it's going to fail. And a lot of our more experienced traders will turn a divergence failure of a transition into a short trade and make an extra 20 ticks. So again, worst case, you're out of your long. Best case, you're able to read that properly and take advantage and go short. Again, remember, large chart trigger line reading, trigger line reading, trigger line reading. In a transition, we have to be protective. In a number one look, we don't have to worry. In a weakening look, we have to be protective. So this is an example right here. Number one look, small triggers above all the others going up. We're long somewhere over here at support and mid bands. This is where the rookies and the novice traders look for any reason whatsoever to bail out of their trade. They say, oh, there's divergence. So they get out with 2 bars down, only to watch the market go back up. And so they jump back in at the wrong price, and they say, uh-oh, pivot stop out, and they jump back out again. And then they lose a little more money, only to watch it run up to the target. So this is the difference between the novice traders and the experienced, confident traders with our software. They have the right entry area. They know the conditions are perfect. They don't let anything spook them out of their position. Stop goes below the pivot, stop goes below the pivot, stop goes below the pivot, and they make $200. Whereas the novice trader's loses some, and then never gets paid. Really, really, really happens a lot. So again, you have to be very aware of whether you're in a number one position, a number one look, and you don't let little stuff bother you or you'll lose money. Now, this is also out of our trading plan on when to stop taking trades. So we're going to go on the assumption that you're short. And again, if you're in a transition period on your large chart and you have triggers that are still crossed up, take the money at fibs on the small chart. Just take your profit. You'll be happy. Every time, over and over, just take your money, take your profit. Because when it's in a transition look, the small chart almost always makes it bounce. Every once in a while they'll run, but you'll find some other way to make money, I promise. Same thing, this is also out of our plan on when to stop taking trades on a breakout. When we break out of a fib, we're going to do a short trade for sure. If you get to a fib or a pivot stop out or something along those lines and the fib has not changed colors, take the money. Take the money, take the money, take the money, take the money. If it's in a transition, if it's in a breakout that hasn't finished, take the money, take the money, take the money. It usually works out best. Now, some of you guys also use the market flow. And again, the market flow is really awesome when you're placing trades. The market flow high volume lines help us out a lot. The white paint bars help us a lot, and they also help us reduce risk or take profits. Here's a couple examples. Real quick, 14-2 chart, we're going up. 8-2 chart's green, we're going up. We want to do a trend trade on our 5-1 chart, so we look at our market flow chart. And usually wherever the green line is, this high volume line that's created from the white paint bar, between that and the support, that's where the market's going to go down to and then go back up from. So the high volume line, when the triggers are crossed properly and the background is the proper color, will help you to fine tune entry spots for trend trades. Now, one of the other things that you'll see that happens a lot, and again, I took this off of a live example that we did in class. We're going to be doing a trend trade short over here on the 5-1 chart, and most of the time, you're going to see this happen a lot. I mean, a lot. You're going to have small triggers going down really strong on your market flow chart, and if you have a white paint bar up, it signals to go short on the way up because the next bar usually will be a signal to the downside. So we want to use the area, the background color, and the fact that we have a white paint bar up to get in on the way up. Remember, buy low, sell high. We want to sell high so we can take our money on the way down. You will see this happen a lot. Sometimes you'll get a white paint bar up and you're going short, and they'll give you one more bar up, but you won't get stopped out, and then you'll get a market flow short signal. Anytime you're already short and you get a market flow short signal, it makes you feel good. One of the other things that you'll see is as you're reaching a target, either a top or a bottom, if you have a white paint bar into that top or bottom, you better be ready to pull the trigger and take that money. Because at fib support, a white paint bar down into it will usually cause a reversal. So again, we use white paint bars to help us enter assertively on the way up, and we can also use the white paint bars at targets to help us get out assertively. One of the other things that you're going to see, and again, my opinion is for new users, you should only do trades when all of the background colors match. If you decide you want to do extra trades where they don't quite match, and say the background color is red on the smaller charts, 5-1 or 8-2, then this is where sometimes waiting for a market flow long signal, instead of just getting in assertively on the way down, you wait for a market flow signal to help you out. And again, the 14-2 chart has to still say it's okay. The smaller charts may disagree, but then if the market flow agrees with the 14-2 chart, you can take that signal. One more word of caution for you. Don't stare at the market flow, ever. Only use the market flow when you're ready to execute a trade or execute an exit. Don't stare at it. It's going to cause you to do crazy things. There's too many false signals that you're not going to use, and it's really imperative that you only use it at the perfect spot with the perfect signals, and then it's going to really be very beneficial for you. Again, if you're looking to go short, the white paint bar down and further price bars down are going to generate this magenta line. As you're trading into the spots, you're going to be able to go short. And then ultimately, if you have a white paint bar going down into a fib support, it's usually a good spot to take profit, not go long. You must really work to ignore signals that have no possibility of success due to the trigger line configuration. We want the fibs and triggers to help us at all times. Again, remember the objective, guys. You could trade 2 or 3 markets, and you can only wait for ultra high probability trades. $400 a day is the consistent key for you to make your money and to make your goals. And again, remember the secret to management. The secret to great management is to do trades that barely need management at all. That's going to be the secret to help you out a lot. Again, pay attention to the charts. If you're in a transition or a weakening, manage with the small charts. If you're in a number one look, relax a little bit. I appreciate you taking the time to go through this management. As you apply it in the real world, post in your charts in the room, and you'll see literally 100 examples a week of how to manage trades properly. Thank you for your time.